you are a young individual investor at home and you have your choice between buying your first home or investing in stocks, where would you tell someone is the better bet?
If I thought I was going to live, if I knew where I was going to want to live the next 5 or 10 years, I would buy a home and I'd finance it with a 30-year mortgage, and it's a terrific deal. And if I was an investor that was a handy type, which I'm not, and I could buy a couple of them at distressed prices and find renters, I think that's and again take a 30-year mortgage. It's a leveraged way of owning a very cheap asset now, and no, I think that's probably as attractive an investment as.
Is a major storm brewing in the U.S. real estate market? That's the question on the minds of many investors and analysts as they grapple with the warnings issued by billionaire investor Warren Buffett. Buffett's recent cautionary statements have cast a shadow over the seemingly buoyant real estate sector, signaling potential trouble ahead. With a debt-fueled tsunami looming over the market, investors are on edge, bracing for the impact of what could be a significant downturn in the real estate landscape. But it all has consequences, and we're beginning to witness the ripple effects of Buffett's ominous predictions. The staggering $1.4 trillion debt burden has already begun to weigh heavily on the real estate market, sending shockwaves through the industry. Yet, this may only be the tip of the iceberg, as Buffett foresees a more profound and widespread impact looming just on the horizon. Warren Buffett's perspective. Warren Buffett, the famous investor, recently shared his thoughts on the commercial real estate market, raising concerns about the abundance of risky loans and the potential decline in property prices. In response to inquiries, Buffett explained that his company, Berkshire Hathaway, tends to steer clear of heavy involvement in commercial real estate due to tax complexities. He foresees significant challenges ahead, particularly in downtown areas across the United States and globally, where property ownership dynamics are expected to undergo significant shifts. Despite the looming storm, Buffett remains cautiously optimistic, believing that while the landscape may change, buildings will endure, even if ownership changes hands. These words from Buffett sheds light on the complexities of the real estate market and underscores the challenges faced by investors and similar property owners. The role of debt in real estate. In the last 15 years, the U.S. real estate market has experienced a surge driven by the availability of cheap debt. With interest rates at historic lows, there has been a significant uptick in borrowing, leading to inflated real estate prices. For instance, consider someone looking to purchase an office building in their hometown, priced at a convenient $1 million. Now, it's unlikely that this buyer has $1 million sitting idly in their bank account. Instead, they will turn to a bank for a loan to cover the majority of the purchase price. In this scenario, the buyer contributes $350,000 in equity, essentially a down payment, and secures a loan from a local bank for the remaining $650,000. The profitability of this purchase is linked to several factors, with the interest rate being paramount. For example, if the buyer secures an interest-only loan at 5%, they'd be responsible for annual interest rate payments amounting to 5% of the total loan amount. Moving on, think of the annual debt payment of $32,500, which is related to making the homeowner's mortgage payment. This payment, determined by a 5% interest rate, represents the financial obligation to the bank. Whether the property can sustain this debt payment hinges on its net operating income, akin to the rent it generates minus associated expenses. In our example, let's say the office building generates $60,000 annually for the owner. This income comfortably covers the debt payment, showcasing the property's financial viability. To gauge this ability more formally, banks utilize a metric called the Debt Service Coverage Ratio, or the DSCR. This ratio measures the property's capacity to meet its debt obligations, calculated by dividing its income, $60,000, by the debt payment, $32,500, resulting in a DSCR of 1.85 times. As a rule of thumb, banks prefer to see a DSCR exceeding 1.2 times, indicating ample financial cushion. With an interest rate of 5% and a net operating income of $60,000, this property surpasses expectations, demonstrating its profitability despite being primarily financed through debt. Impact of rising interest rates. In contrast to residential buyers who often secure 30-year fixed-rate mortgages, commercial property purchasers face a different lending landscape. Commercial loans typically lack the stability of fixed rates, subjecting borrowers to periodic adjustments based on prevailing interest rates. Unlike homeowners who enjoy the predictability of consistent payments, commercial property owners must navigate the uncertainties of fluctuating interest rates. For example, consider our scenario of the $1 million office building. Let's imagine increasing the loan's interest rate from 5% to 7%. This adjustment would lead to a significant spike in the annual debt payment, escalating from $32,500 to $45,500. The sudden increase in debt obligations poses considerable challenges for property owners as they grapple with higher financial burdens. Despite the discouraging prospect of rising debt payments, the property's income remains a crucial mitigating factor. Assuming the property continues to generate consistent income, the owner can manage the increased debt load. However, the vulnerability of commercial loans to interest rate fluctuations underscores the risky nature of commercial property ownership compared to the stability offered by fixed-rate residential mortgages. As the interest rate climbs to 9%, the financial strain on the property intensifies, with the debt payment soaring to $58,500. Despite the property generating $60,000 in income, it struggles to meet the heightened debt obligations. Moreover, the changing dynamics of office space demand, driven by the rise of remote work, further exacerbate the property's predicament. In a scenario where property income plummets to $40,000 due to tenant attrition and increased vacancies, the owner faces imminent foreclosure. With insufficient income to cover the debt payment, the property becomes a liability. Consequently, the bank seizes ownership and sells it at a discounted price, reflecting the diminished value in a declining market. This outcome aligns with Buffett's assertion that while buildings endure, owners may succumb to the harsh realities of financial distress. Non-recourse debt and foreclosure risks. Buffett's insights shed light on the systemic issues plaguing the real estate market. He highlights the prevalent practice of leveraging non-recourse financing, where borrowers secure loans without personal liability. This approach, driven by the desire to borrow based solely on property value, has become commonplace among major players in the real estate industry. Consequently, property valuations often become inflated, reflecting borrowing capacity rather than intrinsic worth. This mindset permeates the sector, contributing to a market environment where borrowing decisions dictate property values. Moreover, Buffett states the consequences of this lending behavior, emphasizing the role of lenders in owning properties due to borrowers' inability to meet up with their repayment. The negotiation between borrowers and lenders, often involving complex financial agreements, showcase the challenges that are essential in commercial real estate development. Despite the scale of these activities, Buffett warns of the impending repercussions, as borrowers who previously benefited from low interest rates now struggle to sustain their investments. This phenomenon underscores the fragility of real estate markets and the inherent risks associated with excessive leveraging and speculative lending practices. When individuals borrow money to purchase a residential property, they are often required to sign a personal guarantee. This agreement holds them responsible for repaying the loan, irrespective of any decrease in the property's value. For instance, if someone secures a $400,000 mortgage for a house and its value declines to $300,000, they remain liable for the $100,000 shortfall. Simply surrendering the property to the bank isn't a viable option, as the personal guarantee ensures that the borrower must cover the remaining amount. Failure to do so could result to bankruptcy proceedings initiated by the bank. Contrarily, the dynamics of financing commercial real estate is different. Large commercial properties such as office buildings, apartment complexes, and warehouses are typically funded through non-recourse debt. Unlike residential mortgages, non-recourse loans do not hold the borrower personally accountable for the entire loan amount if the property's value decreases. Instead, in the event of a shortfall, the lender's recourse is typically limited to seizing the property itself. This means that commercial property owners may have more flexibility in relinquishing the property without facing personal financial repercussions for the shortfall. Consider this example, where a sizable real estate investment firm acquires a property for $50 million. With a $10 million contribution from the firm and a $40 million non-recourse loan from a bank, the purchase is made. As time elapses and the commercial real estate loan reaches its reset period, an unexpected turn occurs. Purchased at the market peak with low interest rates and inflated real estate values, the property's worth dwindles to $30 million. However, owing to the nature of the non-recourse loan, the property owner has the option to relinquish the property to the bank without personal financial liability. Despite losing the initial $10 million investment, the firm can walk away from the property without further financial repercussions. As the repercussions of non-recourse loans unfold, banks find themselves grappling with properties valued below the loan amount, leaving them with little recourse but to absorb the losses. This predicament is not confined to theory. An estimated $1.4 trillion in such loans are due within the next 12 to 24 months. Many of these properties, acquired at inflated prices or unable to sustain increased debt payments amidst rising interest rates, face the specter of foreclosure. The unfolding scenario is already evident in recent events. Starwood, a prominent real estate investment firm, defaulted on a $212 million loan for an office building in Atlanta. Once a flagship property in a burgeoning metropolitan area, the building's occupancy dwindled to 60% from its previous 90% level at the time of the loan's origination in 2018. With the property's value significantly diminished, Starwood opted not to engage in negotiations with the lender, relinquishing the property instead. This event foreshadows a trend, likely to be mirrored in numerous similar instances in the near future. Ripple effects on small banks and businesses. The problems from these missed payments will affect a lot of things, which is not limited to just the buildings. Even though big banks usually handle most banking stuff in the US, it's actually smaller banks in towns and regions that do most of the lending for commercial real estate. They're the ones giving out about 2/3 of all the loans for buildings and such. But don't worry too much if you use one of these small banks. Many of them will be okay, and your money is protected by FDIC insurance if something bad happens to the bank. However, there will still be trouble ahead. These small banks not only deal with loans for buildings, but also lend money to small and medium-sized businesses, which are really important for local economies. If these banks have trouble because of the real estate mess, they might not be able to lend as much money to these businesses, and that could mean fewer jobs, less spending, and slower economic growth in the long run. We will have to wait and see how everything turns out in the real estate world, but one thing's for sure, it's going to be tough for a lot of people. The big question is, who's going to feel it the most? Conclusion. It's a good thing that you made it to the end of this video. I hope this video has provided valuable insights into the real estate market. If you found this content helpful, don't forget to subscribe to our channel for more informative videos on wealth building. Feel free to share this video with friends and family, like it, and leave your thoughts in the comments below. We will keep you up to date with more discussions and updates on economic trends and financial strategies. Your support means a lot, and it helps us keep bringing you valuable content. Thanks for watching. See you in the next video.